consultant research analyst at Nirmal Equities, as the bear perhaps on the sector, and Apurva Prasad from HDFC Securities joining us on the show. Let me begin by asking you, Girish, first up. Do you think the kind of move that we are seeing on Nifty IT as a whole pack, TCS, Infosys, Coforge and whatnot is justified? Was your read-through as positive from management commentary?
So the quarter numbers were probably a little better than what the street was anticipating. Obviously, the street was fearing the worst. So I had heard numbers of negative 2 to 2.5% kind of sequential decline for Infosys, for instance. So the mood was quite negative, and the numbers that were delivered were definitely better than the worst fears. So to that extent, I think that was positive. But having said that, the run-up that we've seen today kind of assumes that the worst is over, and we will probably not see a significant slowdown in the US. I think it's kind of pricing in a no landing or a soft landing kind of a situation in 2024, which I don't completely believe in.
Apurva, so you belong to the bull case, but I want to understand that in the last 2 months, from the peak of pessimism, the IT pack in various proportion, depending on which stock are we talking about, has also moved up. How much of the positivity in your view or improved outlook is in the price, and do you see more discounting going forward?
Good afternoon. So I think a lot of it is in the price, especially the last few months with the multiples, the rate at which it has gone up. It's almost to the tune of 20-25%. That the multiples are up. So yeah, I mean, a big part of the recovery or the anticipation of recovery in the next couple of quarters is probably in the price. But I think what's also important is that there is some line of path in terms of the operational performance. So most of the companies, including the larger ones, there are real prospects of margin improvement. And many of them have held on to margins despite losing revenue. Companies that have lost 10-12% a quarterly run rate basis, they managed to hold on for a different set of reasons. But the fact that with some growth that's expected to normalize, prospects on margins continue to look fairly good.
But within the sector, if you had to take top bets, Girish, in the sense that any stock where you see that there's still value on the table, whether with respect to the valuation being cheaper or the growth being higher, the possibilities of upgrades if you must, which are those stocks that come to mind, Girish?
So today, as we speak, I'm negative on the entire coverage that I have. I cover about 9 stocks. I'm negative on most stocks except Tech Mahindra. Probably I'm a contrarian there. So I expect the EBIT margins, which for Tech Mahindra, I believe will be about 6 to 7%, including the one-offs that they're going to have in FY24, will probably move to a 15% kind of number by FY26. Thereby, I'm expecting a very sharp acceleration in earnings. So it's a mean reversion trade from a margin perspective that I see in Tech Mahindra. I think to me, it looks like a bit of a low-hanging fruit out there. I think most of the companies have been delivering fairly stable EBIT or EBITDA margins, and the potential for improvement there isn't very material. So looking at the picture of a very sharp recovery in growth in FY26, so my call is that FY24 has been fairly weak. FY25 will probably see a mid-single digit growth for tier 1 companies, and probably there is a downside risk to that if my shallow recession situation kind of plays out. But I think that 2 years of pent-up demand will drive a very sharp recovery in FY26 Plus, on the back of that and the measures taken by the management, I think you could potentially see 15% kind of EBIT margins come through for Tech Mahindra. So Tech Mahindra would be my top tier 1 pick.
Increasingly, past few quarters, the one metric which everybody on the street is tracking much more closely than many other metrics in each of these results is the net hiring metric, which has been going down actually. This time round for TCS Infosys, how did you track it, and how important would that be as an indicator of times to come in your view, as their business mix is also changing a lot? Apurva?
Yeah. So I think headcount trend in the recent past has been more a function of how demand has played out, plus the hiring which was done before the slowdown period, and of course the room for bench optimization, which is fairly high about a year back or so. So I think combination of some of this, and over the next couple of quarters, we expect that number to start turning on a net positive. Continues to be a decent amount of gross hiring, but on a net basis, we still see another quarter or so where this number could still be negative, because there is still enough room for utilizations to go up. So, for example, in Infosys case, there is about 250 basis points scope for utilizations to go up, and that's how much volumes can get absorbed. So it varies for different companies, but I think it's more a function of this significant deceleration that FY24 has seen, where sector growth of low teens has collapsed to low single digits. It's really more a function of that. Plus, there are some lead lag factors that are driving that. We've also seen the subcontracting expenses, which is a much more expensive tool. Those have moderated in a big way. And it's very evident in the way TCS has improved its margins. So I think that also continues to be a lever, probably more so for mid-tiers, and the delta and that could provide on earnings could also be significant from that point of view. So again, that also plays into the operational improvement theme.
Before I let you go, Girish, just a question in terms of the BFSI commentary that we heard from NGS today, talking about how it has bottomed and probably growth will come back in Q4 itself. How big a factor do you think it can play? And are you believing what they're saying in terms of discretionary spend showing green shoots, BFSI bottoming?
So I didn't hear discretionary spend pickup related commentary in either of the analyst calls that happened yesterday. I think they're still holding on to the view that discretionary spend has not picked up as yet. Yes, BFSI, there is a expectation that on a QOQ basis, things will improve. Now, I don't know how much you've been following US banks. The US banks have been spewing profits for the last many quarters now at very high rates. Despite that, their spending has been fairly weak. I think that's a function of what they see as unrealized losses on their balance sheet, the potential asset quality issues that are going to come up if there is going to be a slowdown in 2024, and the big problem connected with capital adequacy. So all the large banks have been asked to raise their capital by anywhere between 16 to 25, 30% between 2025 to 2028. And so my sense is that some of these banks are trying to kind of conserve capital and thereby, cut spending and stuff. So I don't know how that's going to kind of play out from a medium-term standpoint because of these factors. But yes, I mean, probably the company's got greater visibility on a QOQ pickup in fourth quarter.
Thank you, gentlemen, both Girish as well as Apurva, for making time and speaking with us. Ajay